Good morning, everyone. Welcome to the Retirement System Investment Commission meeting for December 12th, 2021. I'd like to call this meeting to order. Before we get started, I want to make sure that we don't have any housekeeping items or any things to move around on the agenda or anything like that. Mr. Hitchcock, anything of that nature?
No, sir. Just a reminder for everyone. We do have for the folks who are online, we do have a little bit of a larger contingent of commissioners here in the presentation center of the office. However, the visual appearance of the meeting will appear a lot like it has over the past year or so. So, predominantly you will see, if you're tuning in remotely, you'll just see whatever's on the screen, and won't necessarily see us in the presentation center, just like it has happened before. This will be a hybrid, as we've talked about. This will be much more of a hybrid meeting. So have folks here, folks remotely. We look to the March meeting to be one where it's much more predominantly in person, and the visual that folks will see at that point will be much more like it was prior to the COVID.
Mike, this is Peggy. I'm sorry, your voice is fading out and I can't hear you.
Oh, sorry about that. Can you hear me now?
Yes.
Okay, sorry. I was looking, the mics are in the ceiling, and I was looking down rather than looking up, so we'll make sure that we do that. Just want to let everybody know that once we get back together in March, the plan is for that to be much more like a normal meeting that we had before the pandemic, and what you will see on the screen will be much more like it was back then. But for this meeting, even though there are people here in person, you will see. What you'll see on the screen remotely will be much like it was previously. So, but we're going to get some cameras and things like that so that we'll be able to broadcast the meeting much more like we did. But we will maintain the option for folks commissioners to be able to tune in remotely via Teams. So,
thank you, Mike. Folks, the agenda was published a while back. If everyone's okay with it, could I get a motion to adopt this agenda as presented, please?
I move.
Thank you, sir. May I have a second?
I'll second.
I second. Thank you. Any discussion on adopting the agenda? Hearing none, I'll call for the vote. All in favor of adopting this agenda as presented, please say aye.
Aye. Aye.
All opposed, please say no. Thank you very much. We have an agenda. Next up is approval of the minutes from our September 23rd, 2021 meeting. Those have been sent to you in the materials a while ago. Hope everybody's had a chance to review those. May I have a motion to accept these minutes as they've been presented?
I move.
Thank you. May I have a second?
I'll second.
Thank you. Is there any discussion on the minutes from the September 23rd, 2021 meeting? Hearing no moves for discussion, let's have all in favor of accepting these minutes as presented, please say aye.
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 Anyone opposed to approving these, please say no. The ayes have it. We have approved commissions. Next item on the agenda is the chair report. I have no information for you folks today. Next following that is committee reports, and I'm not aware that any of our committees met since our last meeting.
Audit committee did.
Our Enterprise Risk and Audit Committee met. Is there a report or a motion to be made from them?
The report is online on Watchdocs. So if there are any questions, I'm happy to respond to those.
Thank you. That slipped my mind. The report has been published and is available. Hopefully, those have reviewed it. There aren't any motions to be made on that. And so moving along, next up is the Chief Executive Officer's report, and I'm going to recognize Mr. Mike Hitchcock.
Thank you, Mr. Chairman. The first item that I have to report and on the agenda under my section is approval of the revisions to the Investment Authority delegation policy. I think, as everyone may recall, these edits were presented at the last meeting. We wanted to give everyone a chance to look at the edits, to make sure that there was a level of comfort before there was a motion to approve. So I have not received, in the interim between these meetings, I have not received any additional questions or suggestions for potential amendments. So, to the extent that the commission is ready to move forward, we can.
I'll move to approve. Second.
Is there any discussion on the revised investment authority delegation policy? Hearing none, no calls for discussion. All in favor of adopting this change, please say aye.
Aye.
Anyone opposed, say no. The ayes have it. I think we have an updated investment authority delegation policy now. Thank you.
Thank you, Mr. Chairman, and just wanted to say thank you to the commission for considering the recommended changes. Also, special thanks to Commissioner Condon for working with us to improve, being very involved and working with us to improve this document. And I think it's just a further evolution and of what we've done to achieve a better governance structure for us. So, next, Mr. Chairman, and this is just there's no material for this, but just wanted to take an opportunity or take a chance to solicit some feedback from the commission. I think everyone is aware that every 4 years the General Assembly requires by statute that a fiduciary audit be performed of the commission. The first fiduciary audit was done in 2014, and that was done by Funston Advisory Services. There was a substantial number of recommendations that Funston made for improvements to the way that we operate and to our policies and procedures in 2014. We spent a lot of time implementing those recommendations. Then in 2018, Funston came back again, reviewed. There was another fiduciary audit. Funston was the firm that was engaged again. Funston reviewed our progress on those recommendations, made several more recommendations, but much more along the lines of really getting us to best practice, and also noted the substantial improvement that we had made in the governance structure since 2014 and the implementation of various policies and procedures that they had recommended. It is unbelievably, it is time for us to do it again. So, one of the things that we wanted to do was to have some input into the scope of what the next fiduciary audit will be. Just as a reminder, this is an engagement that is controlled by the state auditor's office. Mr. George Kennedy, obviously is our state auditor. We had some preliminary discussions with Mr. Kennedy, and he solicited our input on what we thought or what we suggested that the scope could be for the fiduciary audit. And we recommended, and it was received favorably, that this fiduciary audit, in those conversations that we have with him, really focus on the substantial changes that we've made to the portfolio through our simplification exercise back in 2020. And also to see, in that spirit, to see, what recommendations that we've had in the past would be applicable, which might not be applicable anymore as a result of such a substantial change in the portfolio and the simplification of the portfolio that we've embedded into the foundational documents of the commission and the SIOP and AIP. So we took that focus and that recommendation to the audit committee. We also received some additional feedback, some good feedback from the audit committee. One of the recommendations was that, in thinking about the evolution of the commission from one being much more of a management committee to now being much more of an oversight committee, and really asking the fiduciary auditor to look into, that relationship and ensuring that the relationship of the commission and staff was one that was, that best comported with everyone's fiduciary duty. And the other, another recommendation coming out of the audit committee, in addition to, what we had proposed as a scope, was also our, for the fiduciary auditor to, to delve into and look at our relationship and our use of our consultants, both our general consultant and our specialty consultant, and really think about what, are we utilizing those in a way that meets with best practice and getting the full benefit from those relationships. So that's the spirit of the, where we are and the recommendations as far as the scope of the audit. I wanted to also give the full commission and make sure that we gave the full commission an opportunity to weigh in on the scope as well. And we will take, the recommendations of the commission and the commissioners to, we'll make sure that those are communicated to the Office of State Auditor and hopefully incorporated into the scope when they put that out for RFP. So this is just an opportunity for, the full commission to weigh in on things that it may want to see in regards to the scope of the fiduciary audit. To open it up for any suggestions at this time for discussion.
Comments and suggestions on the fiduciary audit scope?
I wanted to ask, are there many firms that are capable of doing a fiduciary audit for us? From my limited understanding, I don't necessarily think that it is a deep or wide bench. From what I understand, I don't know, how many firms other than Funston are necessarily, are in this business. I know there are other firms that do it, and some bigger firms that do it much bigger than Funston as well. So, but unfortunately, I can't be completely responsive to your question because it's honestly just a lack of, really knowledge on the kind of the full panoply of folks that are in this business. But we would expect to get more responses to an offering other than Funston.
I would assume so, yes, sir. And again, it's the state auditor is the one who's putting it out to bid. They're the ones who ultimately make the selection. I think there's a recognition that we've had Funston twice. Obviously, they're a fantastic firm, but it wouldn't necessarily be a bad thing to cast the net as wide as possible to ensure that everybody who may be, other firms would have an opportunity to bid as well. So.
Mike, this is Ed. Just a question. Does the state auditors perform any function similar to Funston, or do they simply handle the selection of the organization to do the audit?
No, they're just really their function really is just to engage the auditor and to receive the report, which ultimately goes to the General Assembly. I mean, we're allowed to at our level, when the report's done and we'll get an initial draft of the recommendations and we'll craft the management response. And that's the way that we've traditionally done it, or that we've done it over the past two times that we've had that this has been done. So they're much more in the business of engaging and engaging the auditor, receiving the report, and then ensuring that that's transmitted to the right folks in the General Assembly who ultimately receive it. So the audience really is the General Assembly.
Any more questions or discussions? All right, I think that checks that one off. Anything else from you, Mr. CEO?
Not at this time.
All right, very well, moving on. Next item on the agenda is the Chief Investment Officer's report. And Mr. Berg, take it away, please.
Thank you, Mr. Chairman. Good morning, everyone. I'm going to walk through the performance for the quarter ended September 30th. I will be as efficient with your time as I can be. This performance presentation is going to look a little different than it has in the past, and this is because we are now using an external service provider, Caisa, for performing the performance attribution calculations. So, well, let me pause. Can people on the phone hear me?
Yes, I can hear you.
Okay. Okay. I want to make sure
I can hear you.
Okay. I want to make sure I'm projecting. So before we get into the new material, let me start with the familiar. Here you can see that for the first quarter, we earned 1.56% and outperformed our benchmark by 28 basis points. The first quarter's net benefit payments were $43 million, and this is below the annual run rate due to the legislative inflow that comes in this time of year, and that amount is $110 million. And that's happened for each of the past several years. One change I do want to point out is that the red line signifying our actuarial assumed rate has declined from 7.25% to 7%, and I'm sure you could tell that from the scale. So let me shift to our performance framework for just a moment. Our returns outpaced both the policy and reference portfolios during the quarter, and portfolio structure and manager selection impacts were both positive for the quarter. Now, I've highlighted in the middle of the page the portfolio structure box because our new service provider is calculating our performance attribution on two different investment decisions that both fit inside this box, and I will walk you through that in just a moment. So let's look for a minute at our asset class performance. What stands out here is something that we haven't seen for the last several years, and that is public equities were the only negative performing asset class for the quarter. Some other noteworthy items on this page include the fact that private equity has continued to perform quite well. And I don't like getting excited about a quarterly return, but I am very pleased that our portfolio performed well against a benchmark that also had a fantastic quarter. Another thing I want to draw your attention to is the benchmark return for our real assets portfolio, up 6.4%. That happens to be the biggest quarterly return for core real estate, which is what that benchmark is, since the late 1970s. So that's coming from significant strength in real estate, within real estate in the apartment and industrial sectors. The other thing I'd like to point out is our Portable Alpha hedge funds have continued to perform well. For us, the returns you're seeing here are returns in excess of the LIBOR rate for all periods. And I think it's also noteworthy that we now have a 5-year track record for Portable Alpha. And I'm very happy to share with you that during the past 5 years, our portfolio has earned $1 billion excess return from the decision that the commission made to employ Portable Alpha.
Bravo.
I love being able to say billion, by the way. It's a great thing.
You didn't do like this, though.
Yes. So a minute ago, I mentioned that the performance attribution data that we now receive has additional information in it, and I'm very happy to have this data because it shows me the the performance of each of the decisions that we make. And I want to take just a second and walk you through it. So what I'd like you to do is to think of each of the circles here as links in a chain that begins with the policy benchmark and ends with total plan return. But each step in between reflects an investment decision that we can now measure thanks to CAISA. The first one of these decisions we refer to as the allocation effect. And this just shows us the impact very simply of being over or underweight one of our 5 asset classes that comprise our policy benchmark. So a real live example of this today is our portfolio is overweight private equity and underweight bonds. Now, the second decision is what we're calling the implementation effect. When we choose to make an asset class look different than its benchmark, so this is not a question of the amount of the asset class in question, but rather the composition of that. The impact of doing this shows up in this area. An example of this also in our bonds portfolio, we hold several off-benchmark exposures such as cash, floating rate bonds, high yield, and emerging market debt. So the decision to use those is going to show up in what we'll show you as the implementation effect. And the third decision is what you see here reflected as selection effect. This is very simply our decisions relating to the managers that we hire and how we implement the portfolio. Let me briefly orient you to the graphical output that you'll see in just a minute relating to these effects. On the horizontal axis, you're going to see weighting, and on the vertical axis, you're going to see a magnitude of the outcome. So when there is a y-axis on a chart, you're going to see overweights on the right, underweights on the left, and very simply, the vertical axis is going to measure whether we have added value or not. Therefore, what we'd like to see is things either in the top right quadrant or the bottom left quadrant. The top right indicating that we would have been overweight in something that has done well, and the bottom left quadrant would be underweight something that has done less well. So either of those would have a positive impact on our returns. So at a high level, this is the story of the quarter. Policy benchmark earned 1.28%. Allocation impact added 17 basis points. Implementation impact reduced returns by 11 basis points. And then manager selection impacts improve returns by 21 basis points, bringing us to our 1.56% return for the quarter. So let me give you a little bit of additional detail in each of these areas. So starting with the allocation effects, just to reinforce how this works, each of the numbers you see on this page sums to the 17 basis points that you can hopefully see at the bottom of the page in the green circle. The only significant allocation impact during the quarter happened to come from being overweight private equity. We were overweight, and since the private equity benchmark significantly outperformed the policy benchmark, that creates a significant positive impact on performance. Now, looking into the implementation effects shows us that there were 3 important impacts during the quarter. First, the decision to employ Portable Alpha added value as our hedge fund benchmark outperformed LIBOR. Then 2 other impacts were negative ones, and they share a common cause. You see in the lower right quadrant that both infrastructure and listed real assets underperformed the core real estate benchmark that I alluded to earlier had such a strong quarter. So this nets to negative 11 basis points of implementation effects. And to be clear, there are more effects but we're just showing you the ones that are the most meaningful. And then we see here the manager selection impacts, and the story is largely told by strong returns from our hedge funds and private debt managers. And since there is no way to, since we don't go short an asset class, everything is right of 0%, and we're just showing you returns relative to the portfolio weight. So when we come back to our return bridge, we can see all of these effects bring us to the 1.56% return for the quarter. Now, this graphic just seeks to summarize all of this on a single page, and this will get more interesting throughout the year, but since the fiscal year to date is really just one quarter at this point, I'm going to skip this since it would just be redundant. The notes you see on this page relate to the portfolio's positioning and recent activity. It all flows through to the exposures you will see on the next page, but if you asked me to highlight the most important things, I would point you to two things here. First, the public equity portfolio I'm about to show you was underweight at quarter end. That was simply a function of we had a lot of very strong marks come in after the end of the quarter, which raised the value of the plan. So we wound up making a true-up trade to rebalance our public equity portfolio back to the target. And then secondly, our portable alpha exposure has performed very well, but it is now up to 11.4% versus a cap on this exposure at 12%. Now, portable alpha has been a way that we have been able to make the low interest rate environment work for us, since, as you recall, we add value here to the extent that that portfolio outperforms a cash rate. So I don't see us reducing this exposure anytime soon, but I simply wanted to make you aware of where it is relative to that cap.
Jeff, how easy or difficult or time consuming is it to change portable alpha investment levels? As opposed to private equity, that may be much more difficult and risky.
It would. Private equity would take a much longer time to see a change. Think of portable alpha as it depends upon whether you're trying to make a smaller kind of rebalancing oriented trade, or if you were trying to take the whole thing down. Brian will chime in if I stray off the path. I think we could make a pretty meaningful impact to the level of exposure reasonably quickly. So I think we could move that by several percent in a quarter or two. To kind of tear it all down, I think would take us beyond 12 months, take us into some longer period of time, probably 2 or 3 years, to get 80+% of that taken down, should we get to that point. Is that responsive to the question?
Would we have to sell hedge funds on the secondary market to do that?
No.
No?
No. That would be an orderly liquidation, which I very much would want to avoid.
Right.
Doing something in a less disciplined way. So,
okay. All right. Yes.
Helpful? Okay.
Thank you.
Yeah, I would just add that a lot of our exposure as well is through managed accounts a lot of our exposure is through managed accounts through Lighthouse Partners, and because of that, we have the ability to take down those accounts very quickly. So we can rebalance at least over $1 billion within a month of notice. That's a very quick way of doing it, but there's other ways that we have to be more with the issue. We may have quarterly rebalancing or quarterly redemptions, and we'd have to submit a notice for that. But
thanks.
We can adjust the exposure up or down. Up is a little bit more difficult because we would have to make new allocations to managers, but we have a strong pipeline of folks that we would like to work with if we were to increase the limit.
Okay. All right. So aside from our underweight to bonds and our overweight to private equity, all other allocations that you see here are very close to our target weights, and all asset classes and sub-asset classes remain within the allowable ranges as outlined in the SIOP. As it relates to risk, I want to let you know we made a change to our methodology, and we are now using a 3-year risk model as compared to a 2-year model to estimate risk on a forward-looking basis. We did this to marry with the ways that we have been looking at trailing returns and the way that we have structured the variable compensation program. That said, impacts from this change, in my opinion, were not significant, and this tells largely the same story that it did last quarter. And I will close with this look at how the forward risk estimates differ from the historical volatility we observed in recent years. We can see that the actual volatility as observed in our returns has been well below the reference portfolio during this time, which I do think is the notable takeaway from this page. But let me pause here and see if there are any questions on any of what I've presented.
I would like to ask if our public equity has recovered somewhat since September 30th.
It had a fantastic
Strong October.
October. As you can imagine, November has been less strong. I don't recall exactly the return for November, but it's definitely negative for November. But frankly, this is more normal market activity, granted with some abnormal causes, to have the market down for a quarter every so often. It happens. But since that quarter, it has been net positive.
Jeff, the VIX really spiked yesterday, and do you expect a lot more volatility in the coming months?
I think we should expect volatility not just for months, but for the coming years, personally. I think it always behooves us to expect higher levels of volatility and have a plan for how we exploit that. I did highlight that we have a very strong liquidity position inside of our bonds portfolio with the cash exposure. And that would be something that if things get really interesting again, like they did early 2020, we're in a very strong position from which to react to that. So I don't want to say that I hope that we have high levels of volatility, because I don't want to tempt fate that way, but I do expect it. The path to higher rates will not be a smooth one. But I think as long as it's 2 steps forward, 1 step back, that works for us. But if we get into a situation where it becomes a little less controllable at the Fed, or if markets have real trouble digesting higher rates, it could be more of a multi-year period of challenging kind of ecosystem for equities. But
Thank you.
Jeff, it said, just a question.
Yes, sir.
If rates do start to move up, at what point would we want to consider increasing our fixed income exposure? And if we did, how would we do that?
Great question, Ed. So I think that there's a lot in that, and I don't want this to sound like I'm not answering the question, but I think we have to pay attention to not only to rates, but what is the cause of higher rates? Is it higher inflation accompanied by higher growth, or is it higher inflation without a corresponding rise in forecasted growth? Because that paints 2 very different kind of worlds for us to operate in. if we see higher growth rates accompanying the higher interest rates, I think that can still be a productive, frankly, that takes us back to an environment like we've seen for the last 70 years. If it is more of a stagflationary environment, I think then bonds can be attractive and equities not very attractive. So I think we need to keep in mind it's not simply a what do we do with bonds, but if we're going to move money into bonds, where does that come from? And I think also, and I apologize, I'm throwing a lot at you in the answer here. Higher rates may change our appetite for portable alpha, because the principal benefit of portable alpha to us, as we sit here today, is we're in essence, we're short the cash rate and long hedge funds. So to the extent that hedge funds can outperform an unusually low cash rate, we benefit. But if rates start rising, we have to revisit that and whether or not we still have comfort and confidence in a very low risk hedge fund portfolio by design in its ability to continue to deliver a return in excess of that short rate. So apologies, Ed, that was a fantastic question. I don't know if I've answered it to your satisfaction, but I think there's a whole host of considerations that we have to lay out on the table and evaluate, how is it happening? And I threw the portable alpha answer in there on you as well. So apologies for making a mess of that.
Oh, thanks.
Any other questions for our Chief Investment Officer about his presentation he's brought for us today? All right. Thank you very much, Mr. Berg. Moving on, next item on the agenda here is a strategic investment topic presentation, public equity benchmarking. And I'm going to turn that over to our CEO, Mr. Hitchcock.
Thank you, Mr. Chairman. Wanted to give a brief introduction. This is something that's an issue that's come up quite several times over the past few years, and it's something that came up in our last meeting, and us really thinking about what is the appropriate benchmark for our public equity program. Is there value and diversification? Obviously it's ACWI IMI presently, and really thinking about, is there value with that benchmark and the global exposure and the diversification benefit that we get out of that versus a more concentrated U.S. portfolio that particularly the S&P 500, which by all accounts has had a fantastic decade of returns. But as we think about what's the best portfolio to have on a go-forward basis, when we went through our simplification exercise, our Makita recommended ACWI IMI, but we thought that it would be a good time for us to just to have a discussion on this. Definitely not looking for any decision out of the commission, but given that the topic came up again recently, we wanted to give Makita a chance to walk us through their thoughts on the positives and negatives of each, and the thoughts on whether we at some point should contemplate a change. So at this point, I will turn it over to Makita, and I don't know if it's Allie or Leroy who's presenting, but I'll turn it over to you and just let you know the presentation's on the page, and if you'll let us know, we'll advance it for you.
Perfect. So that sounds great. Thank you. And thank you everybody for the time this morning. It's a pleasure to be here with you virtually yet again, and hopefully in person sometime soon. So with that said, I'll start on the introduction page. As Mike mentioned, we were recently asked to just reevaluate your global equity portfolio and think about a domestic orientation relative to a global orientation that you've employed in the past. And just kind of the key takeaway for this is we are still strong believers that the global orientation of your portfolio is the most prudent path for the fund going forward. So we're going to outline some of the key reasons that we believe that's the case today. And specifically, I think this is kind of a nice time to refresh some of the benefits of international equities in light of the continuous run-up in the U.S. equity market that we've experienced. So with that said, you currently have the vast majority, with nearly 90% of your assets invested passively in the MSCI ACWI. And to answer a question that came up earlier, I was just looking at the MSCI ACWI. It has bounced back thus far in the fourth quarter, and I think we are at 1.74% through last night in performance for that index. So with that in mind, the benefits are on the next page, benefits of investing in international stocks. First and foremost, we think it's the geographical diversification and kind of what that entails, which is the potential for higher long-term return. And Leroy and I will talk about what we believe are the key drivers of that within the context of this presentation. In addition, we think the diversification benefits of having the globally oriented portfolio allows the fund to dampen volatility over time. So we've run some asset allocation assumptions using our models, and we'll talk a little bit about the impact to volatility over time by implementing international stocks within the context of your domestic portfolio. And then specifically, I think this is kind of in the short term, an opportune time to stay globally invested. As we look at valuations domestically, we're at all-time highs. So the stock market domestically appears very expensive, as you all know. And when you look at international equity valuations, both in developed markets and emerging markets, on a relative basis, they're much cheaper than domestic equities, and in some cases even cheaper than historical averages. So we think that by maintaining the global equity diversification, you have the benefit of potentially buying some cheaper stocks internationally when there's very few of those domestically. So page 4 highlights the performance discussion. So we figured that is you know, the big elephant in the room, right? It's hard to get over the fact that we continuously see a run up in the S&P 500, and it begs the question, why do we have these international stocks? So as you look at domestic equities as proxied by the S&P 500, you can see over the past year up 30%, relative to the ACWI up 27.4%. But even more important, kind of over long-term periods, that endpoint or the past couple of years have really fueled strong outperformance on a relative basis. If you look at the 10-year period, up 16.6%, and outperforming a global equity-oriented portfolio by nearly 5% per year. So when we think about that, I think we previously did an endpoint bias presentation with you, I think maybe close to a year ago now, but we reevaluated that within the context of the specific equity allocation here. And if you look at the 90s, that was a period when the S&P 500 outperformed international stocks or global equity-oriented portfolios by 6.5%. That was largely driven by a term called the lost decade in Japan, where we saw equity and real estate market bubbles that burst, dragging down performance in international stocks over the subsequent 10-year period. And then we saw a reversion to that. So we saw in the early 2000s through the first decade of the 2000s where international stocks outperformed domestic stocks. We've since found ourselves now back in the environment where US stocks are outperforming international over the past 10 years. And the key drivers of that, as many of you know, have been those FANG stocks, particularly in this kind of work from home environment and this COVID environment with Facebook and Amazon and Apple and Netflix and Google and Microsoft all kind of consuming a large portion of the domestic index and experience significant outperformance relative to other sectors. So that's driven a lot of the outperformance we've seen domestically over the past 10 years and more specifically recently. But we think that if you look at page 6 of our presentation, you'll see the characteristics. We still believe that the diversification benefits are there for the MSCI ACWI. If you look at the number of holdings in the S&P 500, it's obviously just over 500. And when you look at the ACWI, you have nearly 6 times more holdings. Then if you look at the next line, you'll see that nearly 30% of the S&P 500 is made up of those top 10 holdings, whereas it's only 16% in the MSCI ACWI. So we're experiencing an environment where that significant concentration in the top 10 holdings has been very beneficial with those FANG stocks, but it could work on the other way for you too. You know, that could significantly drag down performance. So having that lack of concentration or lower concentration over long-term periods could be beneficial despite the recent underperformance of it. In addition, if you look further down, you'll see the market cap weightings. The MSCI ACWI IMI portfolio is much more diversified from a market cap standpoint, having exposure to small, mid, and large cap companies globally. And then you can see less concentration again in the information technology stocks in the sector weightings. And then finally, you know, intuitively, it's more globally diversified, and you can see 40% approximately of the MSCI ACWI is comprised of international stocks, the vast majority of that being in developed, but 13% of that being in emerging markets. So in terms of kind of historical correlations, as I mentioned, and Leroy will go through kind of the impact on expected return and standard deviation, but having this diversification dampens portfolio volatility. And it's a byproduct of the fact that you're seeing the lower correlations relative to US equities, you're seeing, you know, 0.74, but then relative to bonds, you're seeing 0.09 in terms of correlation, so even lower than investment grade bonds relative to US equities. And over time, we have seen the correlations kind of tick up and the global economies be more highly correlated, but we do still see the benefits when you're incorporating both expected return, the impact of currency fluctuations, as well as the impact of you know, GDP growth across various segments of the global economy, drawing down on some of the some of the correlations and benefiting the portfolio from a volatility standpoint. So I will pause there and then turn it over to Leroy, and he will do the second half of this presentation.
Thank you, Ali. Can everyone hear me clearly?
Yeah.
Yes, sir.
Perfect. So what Ali just went through was a historical explanation of why the S&P 500 has looked so good in comparison to international investing. I'm going to spend a little bit of time talking about what to expect in terms of future and expectations in the market over a long time horizon. And the key thing here, as Ali touched on, the endpoint bias, is recognizing when you're in those windows, the temporarity of being in those windows, because the markets do change and evolve over time. So we've looked at the projected GDP growth of emerging markets and developed markets here, and as you'll see, the U.S. is in the developed markets bucket at 2.5%, which actually lifts up that number because the average for that group is 2.2%. And you'll see Australia is the only one in this grouping here that exceeds the U.S. in terms of expectation. But if you look over, you will see that emerging markets, that group has a 64% higher average with that 3.6 versus the 2.2, and it has a 44% higher average expectation than the U.S. there. And singling out just a couple of countries here because of the growth expectation, the India number itself is almost 3 times that of the U.S., and the China number is more than 2. And as you know, China has come down somewhat. If we're looking at this number prior to the real estate situation over there, I think this number in June, definitely in March, was at 8% was the expectation for China. But even coming down to 5% still greatly exceeds the U.S. So putting this into an expectation lens, we see that investing outside of our borders has a much higher higher expected up window, if you will. If we flip over to the next page, we have put together some expectations for the asset classes here for U.S. large cap, U.S. small and mid cap versus non-U.S. developed and non-U.S. emerging. And that first two columns, those are numbers combined, collected by Horizon Actuarial Services, and it really reflects views that our peers have. And the last two columns are ours. And you'll see over a 10-year time span, if we're looking at those numbers, you'll see that we have a much more conservative expectation of the markets over this time horizon. And that's the impact, and as noted below, of recent events in the market drives us to think that for instance, that the U.S. markets will perform at a lower level. However, if you look at the 20-year numbers, you'll see pretty much spot on, not much difference at all. But what the theme that's there is, if you look at these numbers, you'll see for both groupings, both time periods, the non-U.S. equity, developed and emerging, are exceeding the U.S. And that's because some of the historical performance is put into these expectations, starting with the mean variance optimization that takes into consideration that the equity markets have done very well, in particularly the U.S. markets, but we do expect, as do our peers, there to be some outperformance on the ex-U.S. side of the equation. And if we flip over to the next page, we get into what Ali was talking about, the importance of diversification. And when we look at this, we look at the key point here is having the most attractive risk-adjusted return. And we get at that risk-adjusted return by looking at the Sharpe ratio, which determines the overall efficiency of a portfolio. And we see by removing the international equity component, the expected return would drop by 30 basis points from 7.33 to 7.03 if we were to have a US only. So that means if you look at the Sharpe ratio, you're losing 2 points there, moving from 35 to 33, 0.35 to 0.33. And that 2 point drop represents a 6% loss in efficiency on an expectation level. And if we were to quantify that in terms of numbers, that comes out over the next 20 years at $1.1 billion less of a return for the portfolio over that 20-year time period. And time again, the Sharpe ratio, you'll hear us talk about this because it's what you're essentially getting in return for the amount of risk that you're taking on. So obviously, the higher the number, the better. And the volatility factor in there looms large as well. And you'll see here, coincidentally, they're exactly the same at 18% for a standard deviation. So if we move over to the next page, these next three slides look at how we look at investments from a valuation standpoint. And you'll see right now with the average PE ratio for US at 17.2 being at 37.1 is literally off the charts here. You're out 2 standard deviations here. So we would deem this to be an incredibly expensive investment. So what that means here also is if you're looking to go up the food chain in terms of US exposure, it's a very expensive endeavor. And if we move to the next slide, you'll see developed markets just slightly above that 21.4 average there, but well within 1 standard deviation. So compared to the US, relatively cheap. And if we move on to the next slide, we have emerging markets. And emerging markets are just below the average. So this is exceedingly cheap. So what this tells us is if we were to look to shift to a US only exposure, looking to buy in and have, forsake our global approach, that would be incredibly expensive and probably an ill-advised move at this point in time, given how well these markets have run up based on what Ali went through on a number of slides, the reasons why that is. And the last slide we have here is a summary going through here. So if we look at the portfolio, we see that you're right on with peers in terms of public equity exposure and how you go about doing this. So you're not an outlier. The commission is not. And we at Makita, we find investing in a diverse methodology prudent because of that higher risk-adjusted return that I just mentioned on previous slides. And as I just mentioned recently, these valuations are incredibly high. So looking at that from that standpoint, switching to a US only would be prohibitively expensive. And we find that staying with the ACWI would be the prudent move to have that global diversification, a better chance at seeking a higher return going forward down that long-term window. And we find that diversification aspect has a lot of benefits for the portfolio from a risk-adjusted standpoint as well. We just threw a lot at you in a short amount of time. Both Ali and I are happy to answer any questions on any of the slides we just presented to you.
Any questions from the commission to our folks, our friends at Makita?
Yeah, this is Bill Condon. I've got a question for either Ali or Leroy, whoever wants it. So if we were to invest in a S&P 500 index, we're basically investing in large multinational companies, I think for the most part. So we would have by that nature probably global diversification in developed and emerging markets, and hence exposure to good GDP expectations in India and other places. So how do we look at that as compared to the information presented? Seems like we're part of the way there. We're probably not where with that kind of global diversification. What was it? 700 or 2,000 companies versus 500 companies or whatever. Yeah, that's pretty large. But anyway, if you could address that might help.
Do you want that, Ali, or do you want me to do it?
You can kick it off and then I will chime in if you want, Laura.
Okay. So when we look at and that's a very astute question, because that's been at the heart of why do we even have buckets here, U.S. equity versus developed, ex-U.S. developed and emerging markets. Why do we even have that? Because these companies here in the U.S. depend on revenues from countries well outside our borders in both those developed and emerging market buckets. But it's also the flip side of that is having access to those companies that have a better shot at that whole global dependency on revenues based on how the economy flows now. And we're seeing that now. Ali mentioned the impact of COVID. And, there's no there's no factory putting out widgets right now. It's the ability to work from home and be productive. And, it's created this great disconnect between the economy and the capital markets, where we're technically still in a recession economically, but the capital markets, as Jeff touched on, there's been some volatility that's re-entered, and we are to expect that. but we've seen these companies be without borders, in some cases without brick and mortar situations. So it's important to have access to investing in companies that aren't technically here on our soil in terms of headquarters. So it's a great question because of the reach of these U.S. companies outside of the borders, once again, for revenues, but it's also the flip side of having companies that are technically on foreign soil that have that same type of reach, and in some cases, better reach. Companies that are doing better than some of the FANG plus M companies that we mentioned during Allie's part of the presentation.
And I think the one other thing that I would know, because I was just looking it up in our database here, is about 71% of the revenues in the S&P 500 still come from the U.S. So while we are getting into an environment where there is more correlation or more convergence between companies and where they're deriving their revenue, I think we're still finding that a lot of the domestic-oriented companies that are in the S&P 500 are still deriving a large portion of their revenue domestically. I think you'd probably find that, you're probably not terribly surprised to hear that given the level of consumerism domestically. However, I think that to Leroy's point, it's important to capitalize on some of these international equity positions that may be less highly valued and have kind of less concentration risk associated with any single portfolio name.
All right, thank you.
Thank you, and thank you for the time today.
I appreciate it.
Any other questions or discussion, Mr. Chairman?
I don't hear any.
All right. Thank you, guys.
Thank you to
Allie,
our,
Leroy, thank you.
thank you to our friends from Makita.
Thank you.
You're welcome.
Mr. Chairman, I believe we are now at the point where, on the agenda, where we would look to recede into executive session. Oh, I'm sorry, we had to delegate best purpose.
Well, before, do we want to excuse the folks from Makita?
I think the first item in executive session, they're welcome to.
Okay,
Yeah,
well,
yeah.
we've got a delegated investment report that should be coming
The
from
last slide.
Sorry.
This is very simple, as outlined in the delegation policy. At our next gathering, we affirmatively share a list of the investments closed under the terms of the delegation policy, and that list is before you today. I know that you've all seen the investment summaries for each of these, but rather than going through them all, I'm happy to answer any questions if there are any.
Any questions for Mr. Berg about the delegated investments presentation he has?
Clocks in as my shortest presentation ever.
Yeah, that's,
and you're welcome for
thank you, Mr. Berg. I think next up on the agenda, not hearing anything different from my CEO that's sitting next to me, I think we are to recede into executive session. May I have a motion to do so, please?
Have a move.
I have a motion. May I have a second to move into executive session?
Second.
I have a motion and a second. Is there any discussion before we vote on receding into executive session?
Mr. Chairman, just to ensure that we state for the record and for the folks who may be tuning in, that the basis for the motion would be to discuss investment matters pursuant to SC Code annotated sections 91680 and 916320 to discuss negotiations incident to contractual agreements for the scope of service of a general investment consultant contract and to receive advice from legal counsel pursuant to SC Code section 30-4-70A2.
Thank you for reading the motion, Mr. Hitchcock. All in favor of receding into executive session now, please signify by saying aye.
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 Anyone opposed, please say no. The ayes have it. We are now in executive session. Thank you, everyone. Anyone opposed? All right, we are now in open session. Chief Legal Officer, there was one item that came up in executive session that's, we need to have a motion and discussion on for it to take. Could you,
You can do it right.
either you or Mr. CEO, that's fine with me, please.
I'll let you.
Okay.
Madam Chief Legal Officer, I'll let you.
Sure. The motion was to approve the proposed scope of service for the general investment consultant search as discussed, and to authorize staff to finalize the preparation of the general investment consultant RFP, and to authorize staff to make any technical revisions or formatting edits consistent with the action taken by the commission.
May I have a motion to that effect, please?
I move.
A second.
I have a motion and a second. Is there any further discussion? Hearing none, I'll call the vote. All in favor, please say so please say aye.
Aye.
Any opposed? The ayes carry. All right. I don't see anything else on our agenda, Mr. CEO. Would it be appropriate now for me to call for a motion to adjourn?
It would be.
All right, call for a motion to adjourn, please. I have one motion.
Second?
I have a second. All in favor of adjourning, please say aye.
Aye.
We are adjourned. Thank you very much, everybody. Happy holidays.
Aye.